Joining us now, Seth Wunder, Acorns Chief Investment Officer. So Seth, let's talk about the wording specifically from Jamie Dimon, in addition to the number that Brian Chung just brought up. And that was the number that jumped out, $428 million to cover future loan losses. What were your interpretation?
And this is all part of the economic cycle. If you look back a year ago, we had a rip-roaring economy and things looked good. Then we got ourselves into fear of inflation, and then the reality of inflation, and now accelerating inflation. And the market's transitioning to digesting what level of economic pullback, recessionary pressures we're going to face. And JP Morgan and the other banks are either getting ahead of that or starting to see that in little tidbits. I don't think it's that surprising. I don't think it should be that surprising to investors. And quite frankly, part of the process is watching stocks adjust to earnings estimates on the downside. But we'll find a bottom at some point well before earnings bottom. So this is one piece of the continuum puzzle.
So to that point then, Seth, do you see these latest reports from some of these banks as perhaps a bellwether of what to expect, or is this really more limited to some of the banks and some of their specific pressures?
Well, the economy is slowing down on a marginal basis quite considerably. I mean, if you look at commodities prices, I mean, you could look at cotton and lumber and even oil for that matter. They are not looking like the inflationary pressures that they were 3-4 months ago. You could look at the retail earnings from several months back, and I'm sure this quarter will not be any better, to say the least. I don't think this is unique to the banking sector. We should have the expectation that broader level economic slowness, rising rates, pressure on the consumer, and so forth will have detrimental effects on the margin for earnings.
Seth, one thing we also did hear from Dimon, he was saying that the consumer is actually in pretty good shape. We're saying that at a time when it almost feels like that certainly is not the case. What's your perspective just on the strength of the consumer at this point in the economic cycle?
So that, I think, is probably the most important point for people to actually understand, is that the muscle memory that I think general investors have, particularly if you think about we've 12, 13 years off of the 08 and the global financial crisis, is that the average investor today really only has that experience to work off of. Back then, we had a very leveraged economy, and particularly a very leveraged consumer, and in their biggest asset being the home. We have a very flushed balance sheet consumer today. And so even though there are pressures against their earnings and their monthly spending, their balance sheet is actually considerably healthy. I wouldn't be surprised if we start orienting some of the messaging and understanding of what an economic slowdown could look like more akin to, let's say, 01 and that time period where the recession certainly happened and we had to work our way through that. But it wasn't the dramatic deleveraging event that we all know from the 08-09 experience. And so to your question, the health of the consumer balance sheet and where they are today, we will go through an adjustment, but it does not look at this moment anything reflective like we saw last cycle.
Which gets us to the question of what the Fed has to do, and some indication on that from Fed Governor Christopher Waller, who said he's open to something larger than a 75-point basis hike, which means 100. And he said the market is getting ahead of itself, pricing in that 100. What's your expectation from the Fed?
Yeah, I mean, the faster they go now, the quicker it slows down later. I mean, it's sort of this forced economic cycle dynamic that they're in. It's definitely tricky for them to navigate that perfectly. I don't expect they're going to get this all right. The reality is they're probably boxed at 75 basis points in this next hike. I understand why that's important. We should talk about it, but it is just one piece of where we'll end up. The more important thing is what rate increases or maybe even lack thereof we're starting to look at into the first half of next year. I also think that's probably what the market's trying to digest. I heard you guys talking before I came on that techs rebounded throughout the day and so forth. I mean, there is this tussle between like how much will be too fast, too soon, and then when they pause as we get there. So. I'm not overly fixated on what this next move looks like. We know it's going to be at least 75. The question will really be 6-9 months from now what we're looking at.
And as investors really try and search for direction, some are looking at what's happening with copper, others more focused on the yield curve, others say, no, look, focus on unemployment when you think about a recession. What are you primarily focusing on?
Well, it's funny. The market works on like a rate of change. And the reason why I say it's funny is my 7-year-old kid the other day asked me, and he said, is $1 really still $1? And there's just the fact that that narrative has gotten its way into the commonplace of even a child. It's like that old adage of when taxi drivers in New York City are giving stock tips and so on and so forth. We've really gotten to a level of extreme. I pay attention to what the market is adjusting from a news perspective. That's sentiment is a super powerful mechanism, and certainly in the upside, but also on the downside as well. I think when you look at it more fundamentally, the reality is the tea leaves that are happening in the market, where it starts to digest news, how money flows start to work. Those are the important things that cause bases and bottoms to start to work their way through. There's no, the market's not going to like raise its hand and say, oh, today's the bottom, earnings are done, inflation's peaked, come in and buy. And so, I pay attention to the range of things that are out there. And I think the really important thing right now is we have digested a ton. Just remember that the market's down 20% in the first half of the year. That's only happened 4 times in the last 100. All 4 times in the back half of the year, the market was up about 23, 24%. Something to just keep in the back of the mind.
No, that context definitely important there as people sort of wonder whether or not to hit the panic button. A big thank you there to our guest, Seth Wunder. Thanks so much.